internal partners, Jason and Cam. So if you guys need anything from us beyond this call today, give me a call, give my team a call. We're happy to help you out. We got a lot of momentum right now in the Express space, especially with the FE Express and IEWell Express. But with that, I'm going to hand this over to Trey Fairman. Again, he's our advanced markets guru. And buckle up, guys. You're in for a treat.
Thank you, Scott. All right, everyone. I'll give you a quick little background, and then we'll get started. So, again, my name is Trey Fairman. I'm a director on the advanced markets team. I am a tax attorney by training. I have a master's in tax law, which is all great, right? But if I was you, you should be thinking, I always think this whenever someone presents me, why should you listen to me? So, I'll give you a little bit more background. I have been selling insurance for over 30 years. For more than 25 years, I was in San Diego as a point of sale wholesaler calling on most of the major Wall Street firms, private banks, trust companies, accountants, attorneys. I got very lucky. The amount of wealth that moved to San Diego starting in 95 until I left at 2020 was just unbelievable. So I found myself meeting with individuals 3 to 4 times a week that were often small business owners with net worths of 50, $100 million and above. So along the way, I was able to collect a lot of what I call language and tools. So make sure that you have your lucky Transamerica pen handy. If you don't, make sure to reach out to Scott to get one. Um, and we're going to walk through what I call the big three. So when it comes to insurance planning, there's only three solutions, and it's in this order. Okay, key person, buy, sell, executive bonus. So I'm going to start with the presentation. I'm going to give you 2 quick slides of stats. And then I'm going to jump into what I call language and tools, which I do not have slides for. So again, make sure you have your lucky pen and sheet of paper handy. All right, so let's start here with some stats. As you see up here on the screen, these ideas work with businesses of any type. I've done them with Fortune 100 companies, but the fact of the matter is 99% of the businesses we meet with are small. Okay, small in the US as defined as
Hey,
500
Trey, real
employees.
quick.
Yeah.
Um, if you're sharing your screen right now, we are not able to see it.
Can't see it, really.
I can't, at least.
How about now?
All right, that looks good. Yep.
That work? Okay. Sorry about
Yep.
that,
Thank
guys.
you.
So again, these ideas work with any size businesses. I've done them with Fortune 100 companies, but the fact of the matter is most of the businesses we run across are small, small being 500 employees or less. That's important to understand because most small business owners, like the name implies, rely on a core group of employees. Okay. If something happens to the owner, who you're going to hear me say tonight a ton, or today a ton, the owner is the keyest employee in any business. Okay, so the number one sales idea to start with is key person insurance, as was outlined in the invite. That's the type of structure you would be looking to set up for a SBA loan. Okay, but again, most of the businesses we're going to talk to are small. I think the most important stat on this slide is the one on the bottom. It is estimated that 46% of the US workforce works for small businesses. Further research would tell you that there's about 100 million of those workers at small businesses that do not have access to a workplace retirement plan like a 401k plan. So executive bonus plays into that one for sure. All right, let's go to the next slide. Um, Good employees know they're good, right? That's why we should always start talking to business owners about key person planning for the business owner. That's where we're always going to start. Good employees know they're good. As you see up here on the screen, it's estimated that about 51% of US employees are actively looking for jobs or at least keeping their eyes and ears open. So one of the challenges that we have is how to help that owner keep the good employees on staff. When a good employee leaves or a key employee, it's estimated on a macro level, upwards of about $1 trillion is lost. But if we zero down on a more granular level, it will cost 3 to 4 times that key employee's income to replace that employee. Meaning, if you have a key employee making $100,000 and they leave, that owner probably has to spend 3 to 400,000 or will lose that to replace that key employee. That may seem like a big number. However, if you think about it, owners work 25 hours a day, 8 days a week. They're super busy running their business. If a key employee leaves, that owner has to hire people to work overtime and or work more him or herself, right? They probably have to incur travel expenses to go out and see key client accounts. They probably have to hire a search firm, right, to go out and find that key employee. And then even if they find that key employee the very next day, they have to invest in training them. And it's going to take a period of time, 6 months to 12 months, let's say, for that new employee to get up to speed to where the other one is. All right, so that's it for the stats. Let's now grab our pens, and I'm going to talk about the 4 reasons why you should be working with business owners if you're not. Then I'm going to give you what I call the 3 opening questions, which is a sales script that I've used, again, over 30 years. Then I'm going to give you a networking phrase to kind of help you kind of drive some more business. So four reasons why. First reason, again, I do not have slides for this. First reason, business planning is often overlooked. There is a huge need. Okay, so as I said before, business owners work 25 hours a day, 8 days a week. They don't get a chance to peer share like we're doing here. Right. Additionally, accountants are still see me in April and let's talk about what you did last year sort of advisors. Make sure you have your phones muted. We're getting some feedback. CPAs are still very much see me in April and let's talk about what you did last year. They're not forward-looking planners. So the first reason you should be thinking about working with business owners is there is a huge need. It is often overlooked. Okay, the second reason. Fact of the matter is most of your competition, even if they're sitting across the table from a business owner, they only talk about individual planning. They do not talk about business owner planning. Okay, so the second reason is you can set yourself apart, make yourself memorable in a good way by being the agent that not only helps individuals and families to be successful, but also can work with small business owners. The third reason, you can organically grow your prospecting list. So by being the agent that can work with small business owners and involving their tax advisor, their accountant in the process early, not only do you do a good job and help that business owner, but that tax advisor that you bring into the meeting, they have another 20 or 30 business owner clients. And guess what? That tax advisor, excuse me, that tax advisor knows reason 1, right? Huge need, often overlooked. Also knows reason 2, most agents don't talk about business owner planning. They just do personal planning. So again, the third reason is you can organically grow your prospecting list. The fourth reason, which I think is most important, is it protects the personal planning that you or a prior agent already put in place. Let me explain what I mean by that. Most agents, again, because they don't talk about business owner planning, if they're talking to a business owner, they don't ask questions about the business. So they don't understand that most business owners have outstanding business loans. Now, we can insure outstanding business loans dollar for dollar. Most carriers can. Okay. But by that prior agent not talking to that business owner about it and maybe securing life insurance to pay off the mortgage, protect the family, send the kids to college, that prior agent doesn't understand. Again, I've worked with dozens of banks over the years. Most business loan notes have a clause in them that say something like, if the financial stability of a business is impacted, we, the lender, have the right to call the note due. And that's exactly what happens in a small business when the owner dies. They're going to struggle financially. So by not talking to a business owner about insuring business loans dollar for dollar on a separate business policy, all that life insurance that was earmarked for the spouse to send the kids to college to pay off the mortgage is gone 30 to 60 days after the owner dies, because the bank is going to call the note due. And all that life insurance, again, goes back to pay back the bank, not to take care of the family. All right, so to summarize for you, the 4 reasons why to work with business owners. 1, huge need, often overlooked. Number 2, sets you apart, makes you memorable in a good way. Number 3, you can organically grow your prospecting list. And then number 4, it protects the personal planning that you or a prior agent already put into place. All right, so let's now talk about the 3 opening questions. This is a sales script that I've used. A lot of these language and tools I got from other people. Some of them I actually made up. What I learned in chatting with business owners, whenever I run a client meeting, I show up, right? I put my folder on the desk with all my life insurance illustrations. I have a short agenda. I always have a legal pad, but I always start every meeting by saying to the prospect, before I get started, is there anything important you'd like to talk about first? Okay, it's important to control sales meetings, but by giving up control in the beginning, why would I do that? We are all problem fixers, right? If we can get a prospect to tell us what the problem is in the first 5 to 10 seconds of a meeting, right, then we're off and running to actually fix the problem. Okay, so the first opening question for a business owner is just simply to ask, do you have 15 or 20 minutes to talk about what other business owners like you, it's very important to say like you, do you have 15 or 20 minutes to talk about what other business owners like you are exploring when it comes to planning for their business? Okay, again, because most business owners work 25 hours a day, 8 days a week, they don't get forward looking advice from their accountant. Most owners are going to say, yeah, sure, I got 15 or 20 minutes. All right, so again, first question, do you have 15 or 20 minutes to talk about what other business owners like you are exploring when it comes to planning for their business? Second question, what's the current tax structure of your business? We're trying to find out if they're a C Corp or an S Corp or an LLC. Now, the fact of the matter is most businesses, 95+% of them in the US are pass-through entities, meaning LLCs or S Corps. So we kind of already know the answer, but that's not why we asked this second question. The reason we asked the second question is because most owners aren't sure of the answer. And that's a great opportunity for us to say to the owner, that's okay. Most owners aren't sure. And then ask, is it okay if I reach out to your tax advisor to confirm the answer and then invite them to be part of the conversation? It's critically important to understand that when working with business owners, that accountant will talk to the business owner, period. It will happen. Whether you're there or not, it's best if you're part of that conversation. So we always want to reach out and invite that accountant to the meeting. They are not very creative individuals, right? They are more tax compliance people. I'm going to share some of the objections that they're always going to bring up. But again, second question, do you have, what's the current tax structure of your business? Goal is to invite that accountant to the meeting. I'm going to pause for a quick second and point out, I think the best source of referrals for small business owners is bookkeepers. I get hit up on LinkedIn. I'm going to share my LinkedIn page at the end, but bookkeepers, if you think about it, meet with business owners once a week, every other week. So they're meeting with business owners a ton, probably 3 to 4 times a month. Accountants are still meeting with business owners once a year in April to talk about last year. So if you're interested in working with business owners, I would still getting some feedback. If you're working with small business owners, I think bookkeepers are probably the best source of referrals for that. Okay, so we did the first question. Do you have 15 or 20 minutes to talk about what other business owners like you are exploring when it comes to planning for their business? Second question, what's the current tax structure of your business? Trying to get that accountant into the meeting. Okay, third opening question. There are 4 variations of this. First question, which I think is the best one, my favorite, I guess. Just simply ask the owner, what are you doing today to be successful you weren't doing 5 or 10 years ago? What are you doing today to be successful you weren't doing 5 or 10 years ago? You may get an answer like, oh, we hired Karen. She's our #1 salesperson. If that's the answer I get, right, that tells me, which is the purpose of this third question, that tells me the next part of the meeting, I should be talking about key person planning or executive bonus planning for Karen. Right? If you ask that question, what are you doing today to be successful you weren't doing 5 or 10 years ago? If you got an answer, oh, I've sort of figured out how to borrow money from the SBA, that would clue you in that we're going to talk about using life insurance under a key person arrangement to indemnify and use as collateral for that outstanding business loan. All right, second version of this third opening question. What changes are you focused on now to reach your goals this year and next? What changes are you focused on now to reach your goals this year and next? We have a question like that on our small business fact finder. I was reading one a few months ago from a physician who answered the question by saying, oh, I have 2 friends that are also physicians and they're going to be retiring in the next year or 2, and I'm going to buy their practices. So if that's the answer I get, guess what? That tells me that the physician's going to have to go to a bank to borrow money to buy out the practices from his 2 friends. And again, remember, we can insure outstanding business loans dollar for dollar. All right, again, this third opening question is meant to be the springboard or the launching pad for the rest of the meeting. All right, third version that I got from an agent last fall. It's pretty good. It's maybe a little bit corny, but just simply ask to the owner, if you could wave a magic wand, what two or three things would you change about your business? Right. Again, the goal here, keep in mind, we have not talked about products at all. As I say, products are important, but that's step two. When talking to business owners, it's critically important to get them talking, talk like a business owner. I'm going to show you how to do that next. Okay. But products are step two. Don't even worry about the products. All right. So again, third opening question. First version, my favorite. What are you doing today to be successful? You weren't doing 5 or 10 years ago. Second version, what changes are you focused on now to reach your goals this year and next? Third version, if you could wave a magic wand, what two or three things would you change about your business? And the fourth version I don't use. It's somewhat negative, but it proves the point. It's just to simply ask, what keeps you up at night? Right? The goal with this is to get the business owner talking, okay? Understand what they're doing, understand what their pain points are, what their challenges are, and how you can help them moving forward. Okay, now, when working with business owners, I think about this as a two-meeting exercise, or at least two parts once you get good. The goal is to gather information, okay? And then understand that business owners don't need you to be the expert, right? They just need to know that you know someone who is the expert. So I think an easy way to kind of close this first fact-finding meeting is just to simply say, as I mentioned, I do work with business owners. I also partner with someone who's an expert and focuses in this area. So let me confirm a couple things with him or her. If that's us at Transamerica, that'd be great. Let me confirm a few things with him, and then set the time for the second follow-up meeting. Scott provided his contact info. Scott and I are on the phone with agents. I'm on the phone with business owners and agents and accountants all the time. Okay, so don't feel like you need to know all the answers. You don't need to be the expert. You just need to let that owner know that you do have contact with experts that actually focus on this area. Okay, so now let's talk about a networking phrase. This one I did not develop, but I think it is awesome. So let's assume you're out at an event, someone asks you what you do, and you say, oh, I work with business owners. And they say, well, what does that mean exactly? The answer to that question is our job as advisors to business owners is to make sure that when the owner exits their company, okay, every owner is going to exit their business, right? They're either going to sell it, they're going to retire, or they're going to die in their chair running it. The networking script is our job as or my job as an advisor to small business owners is to make sure that when that owner exits their company, they leave with the money and the value they've worked so hard to create. It's important to understand business owners constantly struggle to monetize their business. Okay, let me give you a quick example of that. Business owners are great at generating $200,000-$300,000 a year worth of profit, but again, they struggle to monetize or to capture the value in their business. Here's a quick example. We're going to talk about this when it comes to buy-sell planning, but most business owners can sell their business for 3 to 5 times net income. So if I have a business that's making $300,000 after expenses, that owner can plan on selling that business from 3 to 5 times 300,000. So on the low side, it's a $900,000 business. On the high side, it's maybe 1.5 million. Now, if the business has been around for a little bit longer, maybe they can sell it for 7 to 10 times. But for whatever reason, dentists can only sell their business at 1 times net income. I don't know exactly why that is. It's just been like that forever, as long as I've been in the business since the early 90s. All right, so I was on the phone with a dentist. She makes $300,000 a year. Like most dentists, she had outstanding business loans because she has to buy all the equipment in her office. Those totaled about $900,000. So again, she makes $300,000 a year. She's got $900,000 of outstanding business debt. When I say monetize a business, here's the problem. If she died, her husband, who's not a dentist, right, would have to sell the business at best for $300,000. And then he'd have to pay back the bank $900,000 for the outstanding loans. Okay. By ensuring that dentist as a key person, we can insure her easily for income times 10, maybe a little bit more, but let's just use that stat. So she makes $300,000 a year. We can insure her for income times 10. That's $3 million plus outstanding business loans of 900,000. So I can insure her, and we did insure her under a key person policy for $3.9 million. So when I say owners struggle to monetize their business, the way we help in that scenario, right, without life insurance, when that dentist dies, if she dies unexpectedly, her husband can only sell the business for 300,000 and he'd still have to pay back the $900,000 of business loans. By insuring her as a key employee, again, owners are the keyest employee, she will give 10 times her income tax-free to her husband, the next 10 years worth of her income tax-free, and pay off all the outstanding business loans. So when I talk about owners struggle to monetize their business, that I think is the cleanest example of what we're actually talking about. Keep in mind, this is all about financial risks. Okay, so as you see up here on the screen, when it comes to small business planning, there's three answers: key person, buy, sell, executive bonus, in that order. I think it's critically important to understand that and always talk first about the easiest part of this. That's key employee insurance. Okay, fact of the matter is business owners understand their numbers and understand the financial risks that they take in their business. Think about the TV show Shark Tank. Okay, what do those sharks grill the entrepreneurs about? Know your numbers, right? Owners know their gross profit or gross revenue. They know their expenses. They know their net income. So always start by talking to that business owner as the keyest employee and understand that they're struggling to monetize their business. Think about that dentist example. We could give that family the next 10 years worth of her income, guaranteed tax-free, and pay off outstanding business loans. Okay, now let's just sort of walk through who is key. So as I've said a few times, I'm going to keep saying it, owners are the keyest employees. So they're absolutely key. Okay, if you think back to that third opening question, what are you doing today to be successful you weren't doing 5 or 10 years ago? Guess what? Answer to that question is usually a key employee. So let's assume we got an answer of Karen. She's our top performing salesperson, right? So top performing salespeople are always key. Think about businesses. A pharmaceutical firm, I think, is a great example. The lead scientist or the product designer in a business, they may or may not be an owner. That person's key for sure. So someone that's got a specialized skill set or knowledge is key. And then the last point up here, as you see, keep your eyes open for, silent partners or silent owners. I have a quick story on this. I worked with a landscaping firm in San Diego. They were growing tremendously. And there were two owners that were active and actually running the business. I met them, but I didn't meet the third owner to about 30 days after my first meeting. That third owner didn't participate in operating the business, but provided capital to help the landscaping business grow. Okay, so people who provide capital would also be considered key. We've already sort of talked about what the impact is. Keep in mind, research would estimate that 3 to 4 times that key employees' income would be lost. Keep in mind, we can insure them for about 10 times income. Okay, sometimes a little bit more than that. All right, let's do a quick little kind of structure here. Whenever we're talking about key employee insurance, the business is the owner of the policy. Okay, so this is critically important because I see applications and I'm working on one right now. Someone's applying for life insurance to get a bank loan. The application that I got is wrong. It has the business owner as the personal owner. That is wrong. And as the bank as the 100% primary beneficiary. That is wrong. So if we're doing key person insurance, remember, this money is meant to provide benefits to the business. The owner on the application is the employer. The insured is the key employee. And the business would be the beneficiary. Okay, general rule of thumb again, income times 10. For that key employee, they make 300,000. We can apply for about 3 million plus outstanding business loans if it's an owner. Okay. Premiums are not tax deductible. Okay, which should make sense, right? Because we want the death benefit to be income tax free. And there are 2 extra things that we need to know about, because I'll guarantee you the accountant will say this when they show up to the meeting if you're talking to an owner about key person planning. The first point is tax code section 101J. Okay, 101J says that if the business is insuring a key employee and the business does not give that employee written notice and get consent back, the death benefit is possibly income taxable. Okay, so there is a what's called 101J disclosure form. Most carriers need you to sign that during underwriting. Transamerica does not. Okay, we can provide you with samples. You can easily find it on the internet just by Googling 101J disclosure. Okay, but it's important to get that signed whether the carrier wants to see it or not, because without that, the death benefit may be income taxable. All right, so that's the first one to keep in mind. The second one is when a business owns a key person policy, the business needs to file one extra form, which is not our job to do, right? That's on that accountant. It's called Form 8925. It's just an extra informational form letting the IRS know that the business does have a key person policy in effect. Okay, not a big deal, but I'll guarantee you that as soon as that accountant shows up to a meeting, if you're talking about key person planning, first thing they're going to say is, did Trey tell you about 101J? And did Trey tell you about Form 8925? They are not a big deal. 101J is about a page and a half. All right, so keep that in mind. All right, now this is often term insurance, okay? Typically 10-year term insurance. Now, don't think you shouldn't talk about this because term insurance is small cases, right? In my career, the biggest term policy I ever sold was $400 million of death benefit on a key person transaction. We in Transamerica just 2 weeks ago participated in a $150 million key person policy. Okay, so these numbers can get very big. Don't overlook term. Now, let's look at an example using permanent insurance like our IUL product, because I think that also fits a bill for sure. All right, so back to the third opening question. What are you doing today to be successful you weren't doing 5 or 10 years ago? Answer, we got Anna. She's head of business development. She drives 25% of the firm's revenue. So the firm makes about $4 million a year. Anna herself is responsible for about $1 million of that. Now, again, we can use term insurance, but if we use permanent insurance, the advantage to that, as you see over here on the right-hand side, let me see if I can get a pen going here. As Anna's 25% of revenue grows every year, we can structure a permanent policy where the death benefit grows along with it. Okay, now, permanent insurance will cost more, right? So in this example, for this IUL policy, it costs $24,000 a year. But the advantage to using IUL on a key person arrangement is the business can carry the asset on the books, right? So the business can carry this cash value on the books as an asset. That could be helpful in 2 different scenarios. One, I worked with a lot of real estate development firms when I was in San Diego. Those firms have to qualify for bonds every year, which means they have to provide a business balance sheet to the bonding agency. So many of the owners of those firms, as opposed to buying term insurance for a key person, would purchase IUL because they can carry the cash value on the books of the business to make the business look more financially stable. That would be one way to use it. The second way, when it comes to business owner planning, these ideas kind of blend: key person, executive bonus, buy, sell. So the owner could go to Anna here and say, hey, Anna, we want to insure you as a key person for $1 million, right? And then say, this is not executive bonus, but can then hang out the carrot to Karen and say, hey, Anna, or to Anna, if you stay here for the next 20 years, we can talk about possibly bonusing this cash value to you. Okay, so again, this is not executive bonus, but this is a way to kind of use it to do both. Protect the business on a key person basis if something happens unexpectedly to Anna, okay, but then also strengthen the business balance sheet by using permanent insurance. And then also, thirdly, have a conversation with Anna to try to tie her to the business. Say, if you stay around for the next 15 or 20 years, we can then talk about bonusing the cash value out to you. Okay, so that's it for big 3 idea number 1, key person planning. So let's now go to big 3 idea number 2, which is buy-sell planning. All right, so if Scott and I own a business together 50-50, if it's $1 million business, if I die, I'm not always sure why I kill myself first in these trainings, but assuming I die, my half of the business, my 500,000, goes to my family, not to Scott. Okay, so it's important to understand that buy-sell planning involves 2 parts. One, the legal agreement between the owners. So Scott and I, if we sign a legal agreement called a buy-sell agreement, it's going to outline how that surviving owner, what rights that surviving owner has to buy the shares from the deceased owner's family. Okay. That's important. That's part one. Part two is, where does the money come from, right? How is it funded? Okay. Life insurance is perfect for this. So sometimes when I'm chatting with business owners about buy-sell planning, they'll say something like, oh, we don't need to talk about that. I already have a buy-sell agreement. The very next thing out of your mouth should be, how is it funded? Right? Because without life insurance, if I died, most small businesses don't have cash on hand. Right? So it's also important to understand that when you're talking to an owner, if you're talking to me and I say, oh, I'm not going to buy life insurance, who am I penalizing? I'm penalizing my family, right? Because I die, Scott may have the right to buy the shares, but if he doesn't have any cash, who's going to suffer there? My family's going to suffer. Okay, so life insurance is perfect for this. I'm going to share my LinkedIn page at the very end of this, but I did a post on this idea talking about the 4 ways to fund a buy-sell agreement. So let's just walk through those quickly. One is cash. As we said, most small businesses don't have a lot of cash sitting around. 2, Scott could go to a bank and try to borrow money to buy the shares from my family. But remember, owners are the keyest employee in any business. So as I was saying, I died. One of the key employees just died. It's probably unlikely that a business is going to lend to a small business where one of the owners just died. Third one's life insurance. As I said, that's perfect. The other way to do it, and I think it's important to understand this, is what's called an installment sale, right? Scott could go to my family with the legal agreement and say, I'm going to buy the $500,000 portion of the business today, but I'm not going to pay you $500,000 in cash. I'm going to pay you $100,000 a year for the next 5 years. Pay it on installments. Now that just adds risk to the transaction. The story that I share, and unfortunately I saw a few of these. I met with owners in 2009 that sold their businesses, not on a buy sell, they just flat out sold it to someone on an installment sale, right? They sold their business, they gave the business to somebody else, they got one cash payment, and then that buyer was going to pay them, let's say, 4 more payments so that the full price would be paid over 5 years. Those individuals sold their business in 2007. They got one cash payment, and then 2008 happened and the world collapsed. That seller, that owner who thought they sold their business for a boatload of money, got no more cash and got their business back in total shambles. They, in effect, lost everything. So again, life insurance is perfect for funding buy-sell plans. Okay, without it, they either have to have cash or they have to borrow money from a bank, but life insurance is perfect. Now, the reality is there's probably 4 or 5 different ways to fund a buy-sell agreement. I'm not going to talk about those other ones, but this one on the screen is what's called a cross purchase. Okay, in effect, we're going to value the business. I own half, Scott owns half. I'm going to own a policy that insures Scott, and I'm going to be the beneficiary. Scott's then going to be the owner of a policy that insures me, and he's going to be the beneficiary. So I die, death benefit goes to Scott, right, at exactly the right time. He goes to my family with the written legal agreement, says I have the first right of refusal to buy the shares from the family. Here's the cash. That transaction happens. It's neat and clean and easy. All right. So again, when it comes to big 3, first one I always talk about, key person. That's an easy financial risk conversation. Okay. To then transition to buy sell planning, I just simply ask owners, walk me through what would happen to your business if you or your partner passed away. And just pause, right? Usually you're going to answer like, well, what do you mean? Well, you guys are, running the show here. If something happens to one of you, does the business suffer financially? And the answer probably is yes. I mean, owners know they're good at running their businesses, but they also know their partner can't run their business quite as well as they can. Their spouse can't run their business. Their kids can't run their business quite as well as they can. And remember, they struggle to monetize their business. Key person planning helps with that. All right, so those are the first 2 out of the big 3. Again, key person first, buy-sell planning. So let's go to the third one. Now, some agents push back on me and say, hey, look, I always talk about executive bonus planning first. And the reality is most of your competition, frankly, shows up in front of a business owner, puts a 60-page IUL illustration, and basically starts a meeting by saying, let me tell you why this is the best thing since sliced bread. Hey, that conversation is super confusing. Again, my point is it is much better, much more effective to be completely different from your competition, right? Don't swim in that sea of sameness. Be completely different. Hit pause, rewind, ask good, thought provoking questions like the ones that we went through with the three opening questions. Look, as advisors, the fact of the matter is we are judged by the quality of questions we ask. Better questions we ask, the more information we get, but it also helps that client trust us and feel like we get them, right? Now, don't fear that you won't get here. I have always found if you start talking about key person planning, that conversation will naturally progress to a tax planning conversation, and that's executive bonus. Okay, if you start at executive bonus, you're going to run the risk of the owner getting confused. You're going to look like every other agent that's actually met with that person. Take some time, talk about financial risks in the beginning. That conversation will naturally progress to executive bonus. And the good news is you'll probably get two sales out of it, right? You'll get a policy for key person, and then you'll also get a executive bonus sale. All right, so real quickly, let's just walk through what executive bonus is. As you see up here, it's sometimes called a Section 162 plan. That's the tax code section. Now, keep in mind, there are two variations of this. One is for non-owner employees, and the other version of a bonus plan is for owners of small businesses. The taxation of them is a little different, but we're going to talk for the most part about non-owner employees. Okay, after I show the graph, I'll sort of talk to you about owners. But what is this? It is basically a plan that helps businesses attract, reward, and retain good employees. I'll share a quick story with you. I worked with an owner that owned a nurse anesthetist firm in Arizona. Think of physician's assistant. He had about 150 nurses on staff, and he had a tough time keeping his top 5 or 10 nurses on staff because competitors would hire them away. Okay. When I met with him, I asked him in the beginning, what have you been doing? And he said, look, I've been giving them bonuses. So executive bonus does not have to be life insurance. It can just be a cash payment. But the problem he had, which is what most owners have problems with, when you give a cash bonus to an employee, there's no hook to tie that employee to the business. And he was experiencing that. He gave his top 5 nurses cash bonuses, and a few of them still left. Okay, so by using life insurance as part of an executive bonus plan, it provides a hook through a vesting program that encourages that employee to stay on board. Also, keep in mind, these are non-qualified plans, meaning we don't have to get IRS approval. Okay, they're very, very easy to admin. So I'm going to chat about the right-hand side of this page first. So the good news is the sales pitch on executive bonus, it's the same sales pitch you give to individuals about overfunded IUL. Same exact pitch, right? We get tax-deferred growth on cash value. We get tax-free death benefit. We get tax advantage loans and withdrawals. Okay, it's the same reason to buy it. On the left-hand side for the business, right, it sets them apart from their competitors. It is a tax deduction to the business for a non-owner employee. Okay, don't get caught in that. It is not an extra deduction for an owner of a pass-through entity. Okay, as I said earlier, these are non-qualified plans, meaning we don't need to get IRS approval. Okay, they're easy to set up. So think about an owner that owns 3 different restaurants and then has a manager running each of those. She could set up an executive bonus plan just for herself if she wanted, no one else, or she could go to each of those 3 managers and set a plan up for each of them. The premiums do not have to match, right? So manager 1 could maybe get a $5,000 per year bonus. Manager 2 maybe got $7,000. Manager 3 got $12,000. Okay, they do not need to match. Also, it's important, don't shy away from small businesses that have 401k plans. 401k plans are designed for the rank and file employees. And what you'll often find is owners are prevented from saving the maximum amount of money into a 401k plan. I was chatting with a business owner. They made about $400,000. They did have a 401k plan. Now, the maximum you can put away this year in a 401k profit sharing plan, if you're under 50, is about $72,000. This person was making $400,000. They could only put $16,000 away. The reason for that is because they were failing the tax testing on their 401k plan. So get comfortable talking to business owners that have 401k plans by asking this question. If you could put away more money, would you? Okay, so that owner making $400,000 by the financial planning rule of thumb, should be saving 10% of their income, about 40,000. They could only save 16 in their 401k. So when I asked the question, that's great, you have a 401k plan. If you could put away more money, would you? They said, absolutely yes. They also then said, but my advisor says I can't, my accountant says I can't. And I said, well, you can, not in your 401k plan, but let me talk to you about an executive bonus that we can set up just for you. Okay, so it's important to understand when we're doing a bonus plan, if we're filling out the application, the employee or the executive is the owner. The executive is the insured. The executive picks their own personal beneficiary. The business is just the payor. So that means if an owner sets this up for a non-owner employee, makes the first premium payment, because that employee owns the policy, they can leave the next day and take the policy with them. Okay, so the way that we prevent that is we take an extra step called a restricted executive bonus arrangement, or just a REBA, that works like a vesting program within a 401k plan. We put a collateral assignment on the policy that prevents that employee from calling Transamerica and surrendering the policy, pulling out cash value without approval from the owner. We can illustrate this on our software system. Just think of it as the cash value vests at 10% a year. There's a variety of ways to do it. But the agreement could be drafted. Now, it does have to be drafted by an attorney. It's about a page and a half. It's not super complicated. We do have samples. But basically, that agreement would say, I'm going to put $20,000 a year into this policy. If you leave after the first year, employee, you only get 10% of the surrender value. You leave after the second year, you get 20%. Third year, 30%. That's the hook. That's the hook that ties that employee to the business above and beyond just a normal cash bonus plan. All right. Insurance works perfect for this. All right. So let's just kind of look at a quick little chart here, right? So we got business paying the premium, right? Directly to Transamerica. That is a deduction to the business, but it is taxable income to the employee. Okay, so we can structure these as either what's called a single bonus or a double bonus. I'm going to walk through how that works on the next page. Single bonus basically means employee pays tax on the bonus out of their own pocket from separate funds. Double bonus means the business gives that employee extra cash to pay the tax. All right, now I'm going to walk through the numbers up here on the screen. Now, this is not how I sell bonus plans, because I think this isn't the most ideal way to do it, but at least let me walk through this first, then I'm going to walk you through how I do it. So again, back to the third opening question. What are you doing today to be successful you weren't doing 5 or 10 years ago? Answer, we got Mike. Right, Mike's great. We hope he stays here for the next 15 years. He's 45. All right, so in this example, the business is going to pay $30,000 in a premium to fund a IUL policy. Now, the general rule of thumb when you're doing a bonus plan is we can use 30 to 50% of that executive's income. Right, so back to the third opening question. What are you doing today to be successful you weren't doing 5 or 10 years ago? Answer, we got Mike. He's awesome. Next question out of my mouth. That's great. How much does Mike earn? If the owner says he makes about $100,000 a year, I know in my head, right, I can use $30,000 to $50,000 to fund a bonus plan for Mike. It needs to be 30 to 50% of the income that you write on the application. It can be less than that. Okay, but again, we're always aiming for 30 to 50%. All right, so this owner is going to do a double bonus, which means Mike gets $30,000 going into the premium, right? The business is going to give him extra cash to pay the tax on the premium. So I'm going to walk you through the formula. This is the most complicated formula in all of insurance. All right, so Mike's in the 28% tax bracket. We take 1 minus 0.28. Okay, 1 minus 0.28 equals 0.72. If we take the premium divided by 30,000, I'm sorry, if we take the premium 30,000 divided by 0.72, that equals $41,667. Okay, we can check our math because the bonus, the premium, and the extra cash totals $41,667. Mike's in the 28% tax bracket. 28% of $41,667 equals $11,667. That's the cash Mike's going to use to pay the tax. That $30,000 goes for the premium for the IUL policy. Now, again, as I said, I don't sell it this way because this would be like buying a car. If you go to the car lot and you talk to the car salesman and you say, how much does this car cost? They say $30,000. And then a few minutes later, they say, oh, I was wrong. It actually costs 41,667, right? That's what we're doing here. We're starting at 30,000 and we just jacked up the cost of the business. This is a real cash flow item for the business. So the way that I present this to owners is I first define the budget. I say, okay, how much do you want to allocate to the bonus for Mike? I'm going to use different numbers here. Let's assume the owner says $20,000. Okay, let's also assume Mike's in the 30% tax bracket. So I again say to the owner, how much do you want to allocate to the budget for Mike? Owner says $20,000. That's what I can afford to spend per year. So I know my top line number is 20,000. I then ask, great, do you want Mike to pay tax on 20,000 out of his own pocket, or do you want to include the tax payment in the 20,000? Now, most owners for higher paid employees are going to say, oh, I'd like to include it in the bonus. So we got 20,000. Mike's in the 30% tax bracket. 30% of 20,000 is $6,000. So I know I got 20,000 as far as a budget. I'm going to set aside 6,000 for taxes, and then 14,000 will go to the IUL premium. Okay, I think that conversation just flows much, much better because again, this is a real cash flow item for the business. If we do it this way, as shown up here on the screen, we're increasing the cost. And I think just from a psychology of sales perspective, that's not the most ideal way to do it. Okay, so let's just kind of look what ultimately happens here to Mike. Now, again, Mike's 45. We're going to pay that 30,000 for 15 years. So we have 450,000 going into the policy. Now, keep in mind, from Mike's perspective, he didn't put anything into this policy, right? The business put the money in. Yes, Mike had to pay tax on the money, but the business gave him cash to pay the tax too. Okay, so from Mike's perspective, this is the best type of money. It's totally free. If Mike then retires at age 61, pulls out tax-free income from 61 to 90, it's about 50,000 a year, totaling 1.5 million. Remember, Mike didn't put anything in. He just had to promise to stay there and the business would put the money in for him. So he pulls out 1.5 million from age 61 to 90. If he passes away at age 90, his family gets about 364,000. Okay, so these are very powerful for dealing with owners, okay, and then non-owner employees as well. So let me just make a quick comment about doing these for owners. Let me go back a slide. All right, so agents call me, unfortunately, often and say, Trey, you need to help me. I started a meeting with a business owner by saying, would you like to see a way to get an extra tax deduction? Okay, executive bonus plans for owners of pass-through entities, meaning S Corps and LLCs, is not an extra tax deduction. Okay, remember, the bonus is deductible to the business, but it's income to the employee. Owners are employees of their own business. Okay, these still work really, really well. I often talk about a Roth IRA with these, right? I mean, I would just say to an owner, hey, this is not an extra tax deduction, but this removes the money from the income tax system entirely going forward, right? I'll bring up a Roth and owners will usually say, well, yeah, Roths are great. And I'll kind of comment, yeah, Roths are probably too great, right? That's why the IRS limits the amount of money you can put into a Roth, about $8,000. And if you make too much money, you can't put any money into a Roth. So how do we get the same tax treatment as offered in a Roth, meaning after tax money going in? And I would use my fingers. We're going to pay tax on the money going in, the small premiums going in, not the larger cash value, right? We've in effect removed the money from the income tax system entirely going forward, meaning after tax money going in, tax deferred, tax-free growth on cash value, and then tax-free loans and withdrawals coming out of the policy, ultimately a tax-free death benefit. Okay, but keep in mind, it is not an extra tax deduction for a small business owner if that business is an S Corp or an LLC. Okay, so I'm just going to kind of wrap up here, right? We had talked about the big three, right? Key person, buy, sell, executive bonus planning. Okay, keep in mind, it's important to understand that other advisors will get involved. I encourage all the time to get that accountant in the meeting. Look, accountants are not financial planners. They're tax compliance people, right? So there's a couple things they're going to say, not a big deal moving forward at all. We have plenty of good flyers on this. So I'm going to end on this slide. The QR code on the top left-hand side will get you to the Transamerica Advanced Markets page. a lot of flyers about personal planning, business planning, high net worth estate planning. If you're on LinkedIn, please reach out and follow me on LinkedIn. That's my page on the top right. And then also we have a video series called Trey Talks. You can find that on LinkedIn. Now, February and March was business owner planning month for me or for us. So if you go to my LinkedIn page, it's not that far back. I post twice a week, normally Tuesdays and Thursdays, not every week, twice a week, but often. There are plenty of posts about everything that we've actually talked about. There's a post about the 4 reasons why to work with business owners, the 3 opening questions. Trey Talks is a video series that you can find on LinkedIn. You can also find it on YouTube, but I'll caution you, if you go to YouTube and search for it, make sure you search Trey Talks Transamerica. If you search just Trey Talks, you'll find a 24-year-old stud talking about weightlifting. That's obviously not me. Okay, but with that, I am done. We got about 8 minutes. So Scott, maybe I'll turn it back to you, or Bill, maybe you. We can answer some questions if needed.
Thank you, Trey. I have a question. I'm trying to get off.
Oh, we lose it.
Can you guys hear me?
Yeah, there's a bunch of feedback coming in, but yeah.
Can you guys hear me now?
Yeah, much better.
Okay. Is it more? Okay. Is it more feedback?
Yeah, there is now.
Okay. I may not be able to get my question.
All right. Well, maybe I'm just going to look at the chat. There's a bunch of stuff here. Laura asked, "Yep, need to take notes." I'll see if Scott wants to share it. Again, go to LinkedIn. There's tons of information on LinkedIn. I got short videos, short little posts there, so that's good. Aubrey, where can we find the proper structure for key person? I think we already walked through that, right? Business is the owner. Key employee is the insured. Business is the beneficiary. Business is the payor. What else we get? I love the golden handcuffs. Thanks, Laura. Can these work with nonprofit 50C3s? Yeah, I mean, the answer is yes, but let me, and I'd be more than happy to come back and do a presentation about estate planning. So let me give you my take on charities. Charities are great, right? But charitable planning, and again, I'm a tax attorney. I have a master's in tax law. I've talked to people 100, 200, $500 million net worths for over 30 years. Charitable planning is the most complicated, complex planning. In the 5 levels of estate planning, charitable planning is the 5th level, the most complicated planning. So I would tell you, I think talking about charitable planning is in effect a waste of time. I can count on 2, but I put 3 up. I can count on 2 or 3 fingers how many times in my 30-year career I have finalized or even seriously talked to a client about charitable planning. Why is that? One, it's super complicated and complex, and clients just get confused easily and they have to pay huge legal fees. 2, most clients don't realize until later in the planning process that to get charitable benefits, you have to give money to charity, right? Not your family. Okay, so bonus plans do work with nonprofits. I'll give you an easy example. Key person for churches. If I had to define the poster child key person, who is that? The pastor of a megachurch. And in fact, we do tons of key person policies for pastors of megachurches because it's easy, right? So it works for that for sure. Bonus plans work too, though there are some other solutions. Who can help me with talking? Laura. I do that all the time. What I would do is reach out to Scott, and Scott can set up a call for us to talk about it for sure. I think that's it. All right, we got a few more minutes if there are any other questions that pop up.
Can you hear me now?
What would be the best way? LinkedIn. I'm going to get my LinkedIn address. Go to LinkedIn. Oh, Janelle wants me to repeat the networking phrase. All right, LinkedIn address is in the chat. Okay, so networking phrase. Ready? I'm going to count down from 5. 5, 4, 3, 2, 1. Our job as advisors to business owners is to make sure that when the owner exits their company, they leave with the money and the value they've worked so hard to create. I'll say it one more time, and then it's also on LinkedIn too. You'll find it in a lot of the posts. Our job as advisors to business owners is to make sure that when the owner exits their company, they leave with the money and the value they've worked so hard to create. And then if someone hears that and says, well, give me an example, that's the dentist example, right? Dentists can only sell their business for 1 times annual income, 300,000, and they have 900,000 of business debts. We can insure that dentist as a key person for income times 10 plus outstanding business loans. Without a key person policy, the husband could sell the business for 300 and would still have to pay off the outstanding business loans. All right. I think that's it for the chat. I know William was having some, or Bill was having some technical problems.
Yeah. But thank you so much, Trey.
Yeah, more than happy to do this. More than happy. And again, if it's of interest to you, we can talk about doing some estate planning ones, like those 5 levels that I chatted about. We've got a whole presentation on that. And then I'll tell you, we have one more, which is called Language of the Customer, which is really kind of an in-depth dive in all these language and tools and stories that I've been sharing too. So I do have to jump for another call. Thank you, everyone. And Bill, if interested, reach out to Scott. We can do another one some point in the future. Take care, everyone. See ya.
Thanks so
Bye-bye.
much, Trey.
All right. See you guys.